What's the secret to a profitable trading strategy? There's no magic trick. It's about building a solid framework that covers all the essentials. First of all, the direction of the market, so in which direction you think the market will be heading. Then entry levels, so when to enter a trade. Then exit levels, so when to exit a trade, possibly through stop loss and take profit. And at the end, we have to cover position sizing and risk management. In this chapter, we will start to take a look at the first two elements, direction of the market and entry levels, so in which direction we expect the market to go and when exactly to enter a trade. Let's first understand what the strategy tries to accomplish. There are many categories of strategies out there. There are strategies that are trend following, so they try to ride ongoing trends. There are momentum-based strategies, for example the ARM system that I have shared in another course, which takes advantage of strong market movements. There are stop and reverse strategies, which aim to catch trend reversals. There are many different ways to trade the markets, and I believe that you can be profitable with any one of them, as long as you build a solid framework that covers all the essentials, you backtest your strategy, and you find an edge. The strategy we will use in this course is a retracement strategy, so we will attempt to catch retracements. So what's a retracement? A retracement is a temporary reversal in the direction of a price trend, so it's a short-term movement against the prevailing trend. For example, in an uptrend, a retracement will be a short-term down movement before the price continues rising, while in a downtrend, a retracement will be a short-term up movement before the price continues falling. So we are essentially going to trade against the trend. Now, I know what you're thinking. Wait, what? But I've always heard the trend is your friend. Every instructor on Udemy says you should trade with the trend. I've read this in books, seen it on YouTube, it's everywhere. And I understand this reaction. That's exactly why I want to remind you of two things I mentioned in the welcome message. First, keep an open mind until you've actually tried this strategy yourself and seen the results. Second, ask yourself this: all these teachers, authors, and influencers who preach the same traditional methods, how many of them can show you a verifiable, consistent track record? Where is the proof? Have you ever seen one of them with a public MyFX book with a reliable broker, or a verified eToro account, or even a DarwinX or FX Blue track record that shows real-world profitability? I haven't, and trust me, I have taken a lot of these courses. Only here on Udemy, I've gone through probably more than 95% of the courses on trading, and I am absolutely sure, based on 18 years of experience, that not a single one of them is a profitable trader, although some of them are profitable teachers. They usually say that they worked in a big bank or a hedge fund or this and that. When you ask for proof, you either get something that can be easily modified or you get nothing at all. So here is a genuine offer. If you know any instructor, YouTuber, author who actually has a proven, transparent track record of profitability, feel free to share their name in the Q&A section. If their record checks out, I'll happily gift you any one of my courses here on Udemy. And I really mean it, it's not a joke. Okay, let's go back to our strategy. So our strategy falls into the category of retracement strategies, which means we are looking for pullbacks from the main trend. Let's see an example. Here we have euro-dollar on a 5-minute chart. As you can see, the price starts to go down, we have a downtrend, and at one point there's a big down movement, with the price accelerating going down. We want to be here at the end of this down movement to catch a retracement with a buy position and make a profit on this movement. Now, you may think, oh yeah, nice idea. It would be great if we can enter exactly at the end of the down movement and make money on that retracement. But we don't know exactly when the down movement is going to end. We don't know exactly when to enter. For this reason, we are going to introduce an indicator that will help us deciding when to enter our trade, the RSI. RSI stands for Relative Strength Index, and it's a popular indicator in Forex trading, helping traders to understand when a currency pair is overbought or oversold. I skipped the formula because I don't want you to waste time. The calculation of the RSI metrics is automatically done by the trading platform. What you really need to understand is how it works, how to set it up correctly, and how you can use it to enter trades. Let's put a standard RSI on our chart, so we click on Indicators and we search for RSI. And here it is, Relative Strength Index. Let's click on it. We have it now on our chart. We're going to customize this indicator based on our needs, but let's first have a look at what we have and how this indicator is usually used. The indicator shows parameters that can go from 0 to 100. These types of indicators with defined parameters, which are generally from 0 to 100, are called oscillators because the value oscillates between a lower limit and an upper limit, in this case between 0 and 100. We have a horizontal line at 70 and another horizontal line at 30, with the area in between that is colored in a light purple color. We also have a line in the middle showing the level 50, and then we have a purple line which shows the RSI value. And then we have a yellow line which is an average of the RSI over a period of time. When the RSI value, so the purple line, stays in the light purple area, so between 30 and 70, it is said that the price is behaving normally. This means that there are normal levels of demand and supply. When the RSI value extends above the level of 70, the price is considered overbought. This suggests that the recent demand has increased too much, pushing the price too high and creating an abnormal condition. It's expected that the price will move back down to restore normal levels of demand and supply, and the RSI will return to the light purple area, so below 70. That's why when the price goes into an overbought area, traders tend to open short positions. The opposite is true for the level 30. When the RSI falls below 30, the price is considered oversold. This means the supply has increased too much, pushing the price too low and creating an imbalance. It's expected that the price will move back up to return to normal levels, and the RSI will rise above 30 once again. So when the price enters the oversold area, traders tend to open long positions. So to recap, what does the RSI do? It tracks price activity over a set period and assigns a value from 0 to 100. How is it used? It's mostly used to identify when the price has moved too high, so overbought, or too low, so oversold. Now that we know what it is and how it is generally used, we can check the settings and make it more useful for our strategy. Let's go to settings here and let's start with inputs. We will leave the RSI length at 14, which means the RSI will assign a value based on the last 14 candlesticks. Regarding source, we will leave it as close, which means that the calculation will be done based on the closing price of the candlesticks. We leave calculate divergence unticked, and then we have all the settings regarding the yellow line, the moving average of the RSI. We're going to turn the moving average off since we are not going to use it, so we can leave all these settings like this. They are not relevant to us. Then we have the calculation section, in which it asks you the time frame you want the RSI to work with. In the course, we're going to use 5-minute charts, which are quite useful for the day trading type of activity we will have. So if we leave time frame as chart, it means that the calculations of the RSI will be based on 5-minute candlesticks. For our strategy, we want the RSI to work with a slightly higher time frame so that it can capture a broader view of the market. For this reason, it is important that here we set time frame to 15 minutes. Then we leave this box ticked and we are ready to move to the Style tab. The first thing to do here is to untick the box labeled RSI based moving average, since we're not going to use it. When we untick this box, the RSI will not show the yellow line anymore, so we will have a clearer layout of the indicator. A second thing to do here is to modify the parameters of the bands. As we have seen in the standard RSI, when the value goes above 70, the price is considered overbought. When the RSI goes below 30, the price is considered oversold. We want stricter parameters, so we're going to select 75 for the upper band and 25 for the lower band, which means that now we will have an overbought area above 75 and an oversold area below 25. These are the changes we're going to apply to the indicator, and we're now ready to use it to study entry levels. We will open a long position when the RSI enters an oversold area, so when the RSI shows a value below 25, and we will open a short position when the RSI enters an overbought area, so when the RSI shows a value above 75. As simple as that. So in this example of Euro against US dollar, when do we open our position? When the RSI reaches below 25. If we hover with the mouse over this candlestick, we can see that the value of the RSI goes to 24.32, so it goes below 25. It is time for us to enter a long position. On this other chart, we have US dollar against Japanese yen on a 5-minute time frame. The price starts to go up. So the question is, when is it time to open a short position to try to catch a retracement and make a profit out of it? The RSI helps us with that. It crosses 75 right on this candlestick, so here is when we will open a short position. I know you might have questions about stop loss, take profit, when to exit the trade, how to manage the trade, what about position size, and so on. We will cover all of that very soon. This section is only about two things. First of all, identify the direction of the market we want to trade, and second, know when to enter the market. We want to trade retracements, and then we want to enter a short trade when the RSI goes over 75 and enter a long trade when the RSI goes below 25. That's it. There's nothing more I want you to familiarize with for this section. In the next lessons of this chapter, we will explore a few additional concepts to refine our entry signals. Then we will move on to live trades, so you can see exactly how everything works in real time. After that, we will dive into the next chapter, where we will cover exit levels, so stop loss and take profit. And this will add another key piece to the overall strategy that we're going to build step by step. It's like putting together a puzzle, one piece at a time. By the end of this course, all the pieces will come together and you will have a complete, ready-to-use strategy you can apply in the markets to make money. So let's keep going.